I'm Anastasia Moroso here in the iCapital studio. On this episode of Beyond 60/40, we're focusing on wealth tech, and we begin with my private market pulse snapshot. Next, Head of Investment Solutions at Citi Global Wealth, Chris Bitterly, joins me at the desk to discuss the recent collaboration with iCapital on the Citi Wealth Alternative Investment Funds Library. And then I sit down with Hamilton Lane Head of Technology Solutions, Griff Norville, who discusses the latest tech trends in alternatives. Let's get to it. In today's private market pulse snapshot, the one thing I'm focused on is this: a number of reasons for continued market optimism. The iCapital team recently had the pleasure to attend the annual Milken Global Conference in Los Angeles, and the overarching theme that stood out to me was one of hope, optimism, and opportunity. There are no doubt a number of geopolitical and economic challenges across the world, but today I still find at least three reasons for continued optimism for the markets right now. First of all, the fears of stagflation in our view seem overblown. The news mentions of the word stagflation have spiked following a weaker than expected GDP print, which followed a couple of months of hotter than expected inflation. However, that GDP print underneath the surface was quite strong. Private domestic final purchases, which capture services consumption and residential construction, rose a solid 3.1%, which is much stronger than the 1.6% growth headline and is in line with the last 2 quarters of consumption. That is hardly a lack of growth. And we should also acknowledge the relative lack of inflation. Yes, the recent trends have been firmer than we and the Fed would have liked, but inflation is now in the 2 to 3% range. And that is a notable improvement, a notable decline from a year ago, where we were still sitting in the 4 to 5% range. So to us, this is a lack of inflation in the stagflation narrative, and in fact, 2 or 3% inflation can help sustain pricing power of corporations and therefore their earnings. Second, economic growth is improving globally, and it is now tracking around 4%. This is a stark improvement from just 0.8% growth that we saw in October of 2023. In Europe in particular, we are encouraged by the positive impact on the economy of hopefully soon lower interest rates. The European economy had to absorb the interest rate shock since in Europe, on average, 53% of mortgages are floating rate. In the US, that number is only 5%. However, as the ECB is moving closer to rate cuts, most likely in June, we see scope for the economy to improve further, especially as the real household disposable incomes are also forecast to rebound. And finally, third, markets tended to perform well during the prior Fed pauses. On average, returns in the prior Fed holding periods were a solid 9.2%. And as long as growth remains robust, we think the current pause experience should also be positive for markets. Therefore, we see risk assets worth staying in and adding to, in our opinion, and especially for those investors who are still underweight risk relative to their strategic asset allocation. So where should investors allocate capital? Well, we heard that answer loud and clear at the Milken Conference. Investors should consider both public and private markets to fully capture the opportunities for higher potential returns, attractive income, and diversification. And that's your one thing in private markets this week. You might recognize my first guest from her frequent appearances on CNBC and Bloomberg. Kristen Bitterly is the head of investment solutions at Citi Global Wealth and is responsible for all investment products at Citi. iCapital and Citi recently partnered on the Citi Wealth Alternative Investments Funds Library as the first phase of our partnership. Chris, it's so great to see you here today. Thanks so much for joining me.
Thanks for having me. It's great to be here.
It's great to see you. And as I mentioned, we've had a chance to have a market conversation on CNBC and other networks, but it's great to have you here and talk more fully about your role, which is overseeing a number of different products at Citi. So tell us a little bit about that.
Sure. So I am head of investment solutions at Citi Wealth, and effectively what that means is I oversee our product organization. And so the way that we define investment solutions, it's 4 key product areas. It's our insurance business. It is our markets business, which is all of our sales and trading operations, but specifically designed for our wealth clients. There's also a business called Citi Investment Management, which is our investment management business that is dedicated, again, to our wealth clients, delivering solutions like portfolio solutions, SMAs, UCITS funds. And then I think what we're going to talk a lot about today, hopefully, is our alternative and investment manager solutions, which is where we look to partners to be able to deliver solutions across private equity, real estate, credit, hedge funds, as well as traditional mutual funds as well.
All right. Well, that's exactly what we're going to talk about today is the alternatives and also structured investments and sort of the adoption that you see amongst your clients. Specifically, I wanted to kick off with a partnership between Citi Global Wealth and iCapital, and we're in phase one. The funds library has been launched just a few weeks ago, but tell us what it is from your perspective. What does it mean for your clients, and what does it mean in terms of delivering alts to those clients?
iCapital have been fantastic partners, and this partnership actually goes back several years. And so the first phase of this was actually several years ago with structured notes, and structured notes are really important portfolio construction tools. We're seeing actually significant growth this year in the space as people are trying to mitigate volatility. And so everything that we've rolled out in partnership with your team has actually enabled advisors to confidently deliver these solutions. We've actually rolled out educational tools as well. And so I really think that the future is advisor-led, technology-enabled, and that is an example of exactly that. What we're now doing with alternatives is exactly the same. Whether it's education, understanding the role in the portfolio, all of the life cycle events, and that really starts with the funds library, which is just having access at your fingertips to all of the alternatives that are available presently on our platform.
Right. Obviously, we do believe technology plays a key role in managing that life cycle of alternatives, so very happy to hear that we're kickstarting the partnership. And speaking of the adoption of alternatives, right, you know the industry stats and the adoption of alts within the private wealth channel is fairly low. You know, we think we need to get to 20% or 30% allocations to make a difference, but how do you see it? Where are we in the adoption process, and how do we get to 20%?
You know what's so interesting is I actually think we're at the infancy stages, because when you look at the trends of the democratization of alternatives, so a couple of things to think about. Even for investors who are already using this as part of portfolio construction, you just mentioned kind of that 20 to 30%, depending upon your risk profile. A lot of investors who are already active are probably hovering around 10%. So even when you have adoption, there's still opportunities in terms of increasing that exposure. And I think the main reason for that is when you look at the strategic return estimates over time, so not the returns in any one given year, but really over a 10-year period, what are going to be some of those highest strategic return estimates? They're going to come from alternatives. They're going to come from the private equity space. They're going to come from these abilities to invest in some of these long-term unstoppable trends. And then I also think the trend around democratization of alts is a really important one in terms of bringing this to more investors. And we're seeing a blurring of that line between public markets and private markets. We're seeing a blurring of the line as to where can I access some of these themes that I really want to make sure that I express within my portfolio. So it's about democratization, it's about education, it's about strategic returns, and you see all of those things coming together. I think that's a really important part of the portfolio and why we're probably just at the beginning innings.
Right. There's a lot of private clients are interested in investing in the next wave of innovation, whether it's artificial intelligence or decarbonization or gene therapy or other technologies. But as you mentioned, so much more of those investment trends are abundant in private markets versus public. And you also mentioned this notion of public and private markets. And I really heard that quite a bit and across so many different panels at the Milken conference we recently attended. And there was this conversation how last decade was about, you know, the rise of passive investing, but now you have passive and active investing side by side. Well, much like that, the next decade is going to be public and private markets side by side, and you'll tap both to make sure you're getting access to the best opportunities.
I think you're seeing that with the rise of semi-liquid strategies. I also think if we look at the private equity, private credit industry more broadly, if you were to take a 60-40 portfolio, there's a lot of understanding as to where alternatives could fit into the 60%. Now that we're talking about the interest rate environment maybe being higher than what we historically saw, when you're talking about different pressures, then it's also saying that that part of private credit opening up, which the 40% was nearly kind of untouched for a long period of time in
Right.
terms of thinking through what that type of exposure would be. For a variety of reasons, the opportunities that exist in private markets will help augment returns and really create more diversification, which is what we want investors to have.
But let's circle back to the public market conversation and some of the macroeconomic assumptions, because obviously that's a key input into advising clients on products. And, I shared in my private market pulse snapshot that I still think there are reasons to be optimistic. And, I named 3 of them, but I'm curious, where do you sit on the optimistic or not scale? And, what's in store for the second half of the year?
We're constructive on markets. A lot of the volatility that we saw in April, it was almost a garden variety pullback in a lot of ways. And coming off the back of 2 quarters where we saw the S&P 500 deliver double-digit gains, I think some of that was a normalization of some of the extreme movements that we saw. But I think going forward, you almost have to take a step back. And whether it's 2 interest rate cuts or 3 interest rate cuts, we could get into the debate about a lot of things, but there are certain things that are true. And so one, the cash on the sidelines is extreme. $6 trillion plus in money market funds alone. If we look at kind of the totality of cash balances, it's significantly more than that. Earnings troughed last year, and so the recession that maybe a lot of people were anticipating already happened. It was an
Right.
earnings recession, and we're starting to see that broaden out, again, for companies with their balance sheets in order, for companies that can withstand some of this higher rate environment. And then if we add in 2 things, that inflation, while the trajectory isn't linear, it is coming down.
Right.
And that Fed funds have peaked. And I think that when you add it together, if we took that in any other moment in time, that we had cash on the sidelines, earnings have troughed, Fed funds have peaked, and inflation is trending downwards, that would be conducive for risk assets.
Right. And yet cash is still on the sidelines and finding its way into some of those investment products. But speaking of that, help us tie it all together. What would you advise to somebody right now who maybe does have that cash on the sidelines? How should they deploy that, both from a strategic perspective and also a tactical?
So based on everything that I just mentioned, in terms of legging into the market, there are certainly opportunities, and there are opportunities to do so without feeling that you're entering in at all market highs. And so I think when you look under the surface as to what's happening at the index level, even taking a simple expression as doing S&P 500 equal weight as opposed to getting the market capitalization exposure, I think there's ways for you to add exposure, which brings me to the next piece. 2 quick things. One, opportunities within fixed income. I know there's been a lot of historically high volatility within the interest rate market, but you can construct a very high quality fixed income portfolio across municipal bonds, investment grade bonds, preferreds that generates attractive yields, and the coupons alone, I think, merit a place within the portfolio. And for someone who's very nervous, I would say instead of voting with your portfolio to either be all in or all out of the market, take advantage of some of those hedging strategies. Volatility is relatively muted, and if those hedging strategies, because of that, are relatively inexpensive, if that can help you confidently stay invested for the next several months, as we work through some of the things on the horizon, that makes a ton of sense.
Right. I mean, there's always things to work through on the horizon. And Chris, thank you so much for helping us do just that. You can do it all. You could do public markets, private markets, product, as well as investment strategies. So very, very much appreciate your insight and being here today.
Well, thank you for having me. It's been great.
Thanks so much. And thank you to Chris and, of course, Citi Global Wealth for your continued partnership. We're thrilled to be doing that together with you. Today, in our Spotlight series, I'm joined by Hamilton Lane Head of Technology Solutions, Griff Norville. With $903 billion in assets under management and supervision, Hamilton Lane has been providing private market investment solutions for over 3 decades. Thanks so much for joining me here today, Griff.
Thanks for having me.
It's great to see you. And, obviously a lot of our investors know Hamilton Lane well because of the investment management services that it provides. But you run technology solutions. So tell us what that is about and what is the key advantage that Hamilton Lane has when it comes to technology.
Yeah, well, what they might not know is how seriously we treat data and technology at Hamilton Lane. We make it a core part of our key values, core part of our DNA. We've built what I think is the biggest database in the industry. So it's over 56,000 funds and over 150,000 portfolio companies within those funds. We're collecting fund level cash flows within all the way down to the company level, operating metrics of these companies, and even sustainability KPIs. to increase the transparency for our investors so they understand what they're invested in and how it's doing. And so our database today tracks over 60% of all private capital raised over the past 50 years. It's an incredibly powerful tool for us to help educate and inform our client base on the private markets.
Right. And so give us some examples of how you're doing that, and what kind of data you're using and what kind of technology solutions are you providing to clients.
So one example would be on the pre-investment side. So for limited partners that are interested in what investment opportunities are out there, we're trying to open the transparency into those managers. So we see over 1,000 managers a year come through our doors seeking capital. We represent over $40 billion that's put to work every year. And we get a lot of transparency into that GP's track record and the companies they've invested in and how they're doing. And we're giving our clients a technology, we call it Cobalt, that is giving them a side-by-side view of our investment funnel. All of the funds that we're seeing, track records of those managers, details on those companies, understanding of how that manager creates value and how it benchmarks to other managers. That's one example. And you have to understand that to help understand the inherent risks in your portfolio. Down to the company level, how's it doing? And over the years, investors have had a lot of difficulty, but companies are being started from the bottom up now to standardize data and the connection of systems from the GP side to the LP side, just direct data processing downstream. And that's helping track not only financial metrics at the company level, but also things like sustainability KPIs.
Right. And so what's the level of transparency that investors now have? How quickly can they get the data? How granular can the data actually be?
So it's improving rapidly. There's still difficulty in this asset class for a lot of people to get that level of transparency in their portfolio, but there are certain technologies being built. We're invested in a few of them. So one example would be Daphne, which is digitizing a GP's fund offering and their ongoing performance and standardizing that, taking the lift away from a GP, and then delivering that data downstream to LP reporting systems.
So speaking of innovation, let's talk about a few other things that you were focused on, starting with HL Innovations. What is it? Tell us about that.
HL Innovations is our bigger name for our focus on investing off of our balance sheet in technology companies that are going to change the way this asset class does business, pull us into the digital age of private markets.
We can't talk about innovation without talking about artificial intelligence. So what are some of the efforts that you're focused on to infuse AI into your processes?
Well, with AI, we think having proprietary data is key, and we have a lot of it. So we are building something from the bottom up. We call it Helix by HL. And what this AI tool is going to do is be able to access Hamilton Lane's research and intelligence and speak with our voice to help educate our clients and newer investors in this asset class into private market concepts, and then help them understand what are the available opportunities out there, how to benchmark those, all through a unique interface that is not overly complicated, but opens up understanding and access points to this asset class.
Right. So it's kind of like ChatGPT, but exclusively for private markets data.
Exactly. Yep.
And speaking of that, speaking of other tools, benchmarking and also forecasting is quite important for institutional clients and also financial advisors. So I know we have a forecasting tool that's also part of the offering as well. Tell us about that.
Yeah, so I think very uniquely, we've got this data science team internally that we staff, and they are an incredibly bright group of individuals that study 50 years worth of market history. And we've got this great database, cash flows in and out of funds, performance at the company level. And what our forecasting tool can do is it can run scenarios. So what happens in a recession would be one simple example. And every strategy within the private markets reacts differently. This is not just buyout and venture capital anymore. Private credit, real assets, infrastructure, energy investments, each of these has demonstrated historically unique behaviors in different economic cycles, and we can help an LP navigate the potential returns and cash flow profiles in their portfolio.
So Griff, my last question for you is really about what progress are we making in terms of adoption of technologies such as yours? Do you see great adoption or great pushback?
Well, I think the biggest challenge is change management. There's a lot of inertia in this industry to just do things the way that historically people did to be successful, but this industry is changing very rapidly underneath us. The ground is shifting, all these newer investors coming in from the private wealth world. If you are not focused on adapting these technologies, increasing transparency, you are unlikely to attract capital from the newer generation of investors. And so there's going to be, in our view, a separation between the winners in this asset class and those that fall behind by not focusing on data and tech.
Right. And that's exactly what I usually say about artificial intelligence. Either adopt it and do it quickly or be left behind. And it sounds like that's really what's happening in the land of alternative investments as well in private markets is the need to adopt this technology is really, really great. So you are not actually left behind. So Griff, thanks so much for joining us today and for telling us about the innovations at Hamilton Lane, including HL Innovations and lots of other interesting developments and tools. Thanks so much.
Thanks for having me.
And we'd like to hear from you. Send us an email to yourquestion@icapitalnetwork.com and let us know what questions are at the forefront for you and your clients. I'm Anastasia Moroso, and thank you for joining us today. We'll see you next time on Beyond 6040.